Hi, I'm Mike Guterri with MyInsuranceClassroom.com, and today we've got another Insurance 101, teaching you everything you need to know about insurance so you can have the right benefits. Today we're going to explain the differences between term insurance and permanent insurance. How do they work, and what do they do? So first, let's discuss term insurance. Term insurance I like to discuss is temporary insurance, because term insurance is specifically for a period of time. It is really intended for things like your mortgage, for paying off loans, or for college education. Most term policies will have a specific time period of 5, 10, 15, 20, or 30 years. Now, during that time period, term insurance is very, very inexpensive. However, at the end of that term, rates will jump significantly. So as you can see here, in year 21, this policy goes from $895 a year to $21,000 a year, just because the term expired. So for years 1 through 20, term insurance can be very, very affordable. So what's the benefit of it? Well, ultimately, the way that I like to think of term insurance is you are getting a death benefit and nothing else. So it's much like renting an apartment. When you rent an apartment, you get to live somewhere for a specific period of time for a specific dollar amount. But at the end of that period of time, you have to renegotiate the contract, and ultimately the landlord gets to decide if they want to keep you around or not. At the end of your term insurance, the insurance company is saying, we really don't know if we want to insure you, so we are going to make your rate jump really, really high at the end of it. And so when you have a mortgage for a specific period of time, or you need to cover your children's college education for a specific period of time, term insurance will always, always be your cheapest option. But what about for those needs that are not temporary? What about for the needs that are permanent? Leaving money to your heirs, paying for your funeral, income replacement for your loved ones. That is where a whole life or permanent product can come into effect. And so there are many different ways of getting a whole life product. You can get whole life, universal life, indexed universal life, variable universal life, and it can be a very, very confusing conversation. So what I want to do is just explain the basics of how they work. So first, understand that a whole life product is very similar to owning your home. You see, when you own your home, you build equity in it. A whole life product will build cash value. With the equity in your home, you can borrow against it. You can take that money out. You can use it for whatever you want. Well, that's exactly how a whole life product works. You can take that cash value from your insurance and borrow it. Use it for buying a home. Use it for buying a house. When it comes time for the kids to have their wedding, you can use that money for whatever you want. The other thing is that when you buy your house, your mortgage, your rate is locked in typically forever, unless, of course, you get an adjustable rate. Well, that's exactly how whole life works. When you buy a whole life product, your insurance rate, your insurance premium will be locked in forever. Not for 5, 10, or 20 years, but all the way up till age 120. Your insurance premium is guaranteed to not go up. And so that's why when you need a permanent product, a permanent insurance policy like a whole life or a universal life is typically more advantageous. The other thing is when you have your house, if you miss one mortgage payment or 2 mortgage payments, you're not going to be evicted. You typically have to miss multiple payments over an extended period of time before they'll kick you out of that house. Well, again, that's how whole life is going to work. Missing 1 insurance premium, 2 insurance premiums won't cause the policy to go away. It's really not until you've missed multiple payments over an extended period of time that you risk losing that policy altogether. Conversely, on a term product, the minute you miss a premium payment or 2, that's when that policy can go away. So the flexibility on payments is going to be much more easy to deal with on a permanent product. So at the end of the day, you should talk to someone who knows the ins and outs of these products. Talk to someone who really understands what your needs are and what you're trying to accomplish. If you're looking for just death benefit for a temporary period of time, term insurance is probably the way to go. But if you're looking to build cash value, if you're looking to be able to borrow against that cash value, if you're looking for something where the rates will never change, then a whole life product is going to be more appropriate for you. Certainly that product will be more expensive, but it's also going to keep that rate for the rest of your life. So that's the basics of term insurance versus permanent insurance. That concludes another topic of our Insurance 101s. I'm Mike Kateri with MyInsuranceClassroom.com, and remember, there are only benefits if you get something out of it.